James, hi, good afternoon.
Hi, good afternoon.
What you ordered?
Yes, very much, thank you.
I went light on the caffeine as you asked.
Well, thank you.
James, I wanted to talk to you. I remember my English teacher a million years ago telling me about Mark Twain. Mark Twain said, lies, damn lies, and then statistics. So you've just done another comprehensive survey in the wealth management space. You do those on a fairly frequent basis as an organization. And you've really teased out some really interesting findings about wealth management and the next generation. Before we kick off, I've got to ask you the question. You had responses from 1,001. 1,001, I mean, I guess we have to conclude it's very accurate. Not 1,000 or 1,005, but 1,001. How representative is the sample in terms of income spread and in terms of its national coverage?
Well, the key to most of our research projects is we'll have set quotas in terms of the responsees. So, for example, with that 1,000, or 1,001 as you say, we had 400 which had investable assets of 50,000 to 250,000. A similar number which are 250,000 to a million, and then the 200 mark with the high net worth of all having a million plus. So The key was that we needed to speak to wealthy investors because obviously we deal with the wealth management industry and their main client base. They need that certain level of wealth.
You also made a distinction, if I looking at the report, between, I guess it's a pretty broad spread, between younger investors, 18 to 49, and then those over 50. Why was that distinction important?
Well, the topic this year was very much the next generation. So with most wealth managers that we speak to, the average age of their clients is maybe early 60s. But if they're going to boost the asset levels that they need to deliver the performance that they need, then they're going to have to target the next generation. So the key for us this year is to find out if their views are actually the same as the existing client base. Have they even been approached by wealth managers? And what sort of service proposition are they expecting if they are to invest with this industry?
I mean, besides the obvious age differential, someone, I don't know, in their early 20s versus someone in their 30s or someone in their 40s may well have slightly different investment priorities. Did you pick up any material differences between the two groups?
Quite a bit, actually. I mean, obviously, social media, it's much more for the younger generation. I mean, when we spoke to those aged 50 plus, they pretty much had no interest in it whatsoever. They didn't want to communicate with their wealth manager in that way. But the next generation were far more open to it. Also, even just using simple things as the mobile applications. Again, it's the next generation, they almost expect it to be a given within not just, financial services, so most of them will be doing their online banking through a similar app. Now they actually want their wealth management portfolio in the same manner.
In the wealth management space, your research has sort of teased out that there's a bit of a digital divide between those north of 50 and those younger than 50, yeah?
Very much so. But I'm not saying that technology is everything for these investors, though, because one of the key findings as well is that both sets of age groups wanted the face-to-face contact. And so when they're receiving financial advice, it's not to say that it's all got to be through technology. They very much want to sit there on a one-to-one meeting with their advisor, and that is actually their preferred choice as well. So it's not, I don't think, there's a lot of talk about robo-advice.
Okay.
I think it has a place, but it's certainly not going to take over in the next few years. So the next generation, they may use a robo-advisor, but they still very much, there's value in the traditional portfolio manager, for example.
So for the avoidance of doubt, robo-advice means I interface through some digital platform, whether it's on my smartphone, tablet, or through a web browser. I go through a series of suitability questions. I put in my circumstances, my risk profile gets revealed, after which I then get, well, we can debate whether it's advice or whether it's guidance because there is a difference in a legal difference in meaning. But with that, I then make investment decisions based on that. Yeah.
Well, quite often, I mean, the next step as well, once they've got all your statistics and your fact find responses, they actually have a model portfolio. A number of firms do.
Okay.
So rather than you then changing it for your own investment decisions, it's more that here's a sample of funds or even individual equities which we believe suit your profile best, and then you almost take it on as a discretionary service. So effectively you invest your lump sum in that. Unless you've got a certain amount of wealth, you probably will not have much of a bespoke portfolio.
Okay.
So it's normally, it's because it's not actually feasible for a wealth manager to operate in that manner, because it's far too costly to be bespoke for every individual client.
Sure.
So quite often they leave it for maybe those with $1 million plus, where you can truly get a bespoke service.
Well, I was going to ask you, I mean, we're talking about the sort of next generation, and that they have a preference for technology, but based on what you're telling me, they want technology, but they still want that manager touch.
Yes.
In some shape, form, or size. Here's the proverbial big question. Is it robo-advice, as in this comprehensive end-to-end service, or are we talking about robo-admin, providing a range of services that complement what the manager does?
I would probably go more towards the robo-admin is what they're actually after.
Right.
So they want to access their portfolio not just online through their desktop, they want to see it on the go through their mobile. But at the same time they realise that what they're essentially paying for is a luxury service, it is financial advice.
Right.
So if they're just getting an automatic portfolio generated for them, I would assume they would struggle to see where the true value is from that. And so obviously the fees associated with it, why am I paying X% for this management, whereas simply I could almost do this on my own, a self-directed service.
Okay. Well, that's an important point. So let's target that down. I have looked at the report, and it looked to me that there was a very strong correlation between the top three elements that the next generation, and I guess the present generation, or the older generation, both value. Those were things like investment performance, things like branding and trust. Is that borne out by the data?
Yes, I mean, investment performance has always topped our tables when we've asked what's the main reason you choose a particular wealth manager. And that's not too much of a surprise, because you're not going to invest your money if you're going to lose out on the end of the day. But normally it's been fees as a tight second. Mm-hmm. But I think with the increased transparency, they are still very important. They're not quite as important to the investor as they were in previous years, because price competition means most firms charge a very similar amount. But what the key difference this year we found is the brand and reputation.
Okay.
It is now, in fact, it was voted most frequently in terms of the number one reason why they now choose the wealth manager. And I think that's got to be associated with some form of diminishing trust in the sector. In fact, one of the other questions we asked is what do you think, how do you view your trust in the private client investment sector? Has it changed in the last 12 months? And if anything, there was a net decline. I think the figures off the top of my head was 16% felt that their trust had reduced in the last year, compared to only 13% which said it increased.
Let's talk about trust, because trust is a pervasive issue across the entire financial services sector. I saw a table in your report that, if I read it correctly, said that in terms of financial advice, your 1,001 respondents looked more, by a factor of 2 or 3, I think it was, to an IFA or to a professional finance advisor, as opposed to a wealth manager. How does that square in this new world where you're saying trust matters? Does trust matter for the wealth manager, or does trust actually matter more for the IFA or for the professional advisor?
I think it's key for both. So
Okay.
quite a few of these investors have their own professional financial advisor, or PFA or IFA, and that firm may well outsource a lot of the discretionary management to the wealth management community. So in some cases they'll feel that the main advice is coming, the end investor will feel the main advice is coming from the financial advisor, whereas realistically a lot of behind the scenes is a wealth manager. So that's why quite often when we ask the question, who do you go to for financial advice, the instant response is the PFA. Realistically, if the trust isn't there with their initial financial advisor, then well, quite simply, they most likely would go direct to the wealth manager. I would assume so.
Okay, so let's try and take some of these strands and sort of bring them to some takeout actions here. We've said that, and where we started the conversation was, you've done a cross-sectional study looking at financial services, looking at wealth management and the next generation. We've cited 3 areas where actually there's a fairly strong correlation. You've teased out already that those under 50 want more DIY, more do-it-yourself digital tools than perhaps folk in the older peer set that you set out there. Are there any other key differences between the 2 groups that are worth teasing out?
In terms of individual services, the next generation were very much keen on finding out a lot more about pension advice and tax advice.
Okay.
So I think there's been a lot of media coverage around about the new rules in place and the new pension reforms. So I think now they're much more on the ball in terms of thinking, I need to know a lot more in this area. So that's why they're very much pushing for those sort of advisory services to be involved in the whole package when they use a wealth manager.
So let's assume and suspend your disbelief just for a moment that I am the CEO of a discretionary fund manager. What are the 2 or 3 key takeouts from your survey that I should be sitting down with my team in a Monday morning meeting and sitting down and saying, ladies, gentlemen, this is what our agenda needs to be? Can we tease out from your survey what those key points are?
Well, investment performance is always going to be a key point. That should be on a day-to-day conversation with the CEO and his team. So you're always going to have to deliver performance and in some way try and differentiate yourselves from the other competitors. One other thing I haven't really mentioned so far yet is that there's a communication issue. So one thing we found was that 1 in 4 of the next generation who aren't using the same wealth manager as their parents were never had any form of communication with that firm. So the firm never even picked up the phone to ask if they'd be interested in just meeting to discuss potentially investing with them.
So you're actually saying there's potentially a lost generation to existing wealth managers?
So I mean, it's a huge amount of money, and obviously because they're all staying with these firms for 5+ years, the amount of fees that amounts to is astronomical in some cases. So it's a case that they've got to be saying, they've got these CRM systems in place, are you speaking to the children of your clients? Because they are most likely to inherit the wealth, and it just seems it's the straightforward way of keeping your asset levels at least as they are. So you're missing out on a huge amount.
So if I was that CEO, I'd be sitting down and saying, Mum and Dad trusted us for all those years with the family money, but we as a DFM, we are not actually getting into the business of actually actively marketing, actively reaching out to the descendants, to the children, to the other family members.
So they've really got to just speak more. It should be quite straightforward. Why are they not just picking up the phone and speaking to these people? They're going to have the wealth. Quite a few of them, not only will they have the inheritance, they're generating their own wealth as well.
Sure.
So they've got sizable existing salaries. Couldn't believe that when the figures came in, that it was only 25% had been approached. Because it's just a vast amount of assets and the potential revenue involved with it.
So 3 out of 4 actually are being ignored.
Completely ignored. So it's not a surprise they've gone elsewhere, because I wouldn't be surprised if most of them didn't even know which wealth manager their parents were with. Because obviously quite often the parents aren't necessarily going to share their full financials with their children. I mean, they may be pushing on the children, maybe knocking on the door when it comes to inheritance time, but it's just astonishing.
Well, James, on that note, and thank you for those insights. Appreciate your time.
No, thank you very much.
Thank you.
Cheers.